good morning, everyone. Well, good afternoon now, I guess. Thank you all for joining us today. As Carolyn said, I'm Paul Featheringill. I'm the USC Region Director with the Small Business Development Center. And for those of you who might not be entirely familiar with us and what we do, we are a network of highly trained professionals located in, it's actually 21 centers around the state. We offer no fee, individual one-on-one confidential business consulting. We assist both existing and startup companies in any kind of industry at any stage of growth and development. We also conduct educational workshops such as this one, and we provide access to and referral to business resources such as our friends like William Furman and Earl at the SBA. So that's a little bit about who we are and what we do. So our topic today, what we want to get into is, are you ready to borrow? What sorts of things do you need to have in place? What sorts of considerations do you need to have in mind as you get ready to borrow and look at different financing avenues for your business? And these things are applicable to you, whether you are a startup looking for funding to open your doors, or whether you are an existing business who is looking at opportunities to expand, new products, new markets. You need working capital for growth. So these things are going to be applicable, most of them, no matter what stage you are at for your business. And the other thing that I want to emphasize is that as the SBDC, we can provide you assistance in all of these areas to help you to make sure that you're in a position of being ready to borrow. And then when you do identify a lender and you go, one of the first things that they're going to give you, and I'll show you in a little bit some of the things that are on there, but they're going to give you a loan checklist, a loan application checklist of all of the things that you're going to have. And it's going to be at least a page, maybe more. And some of the stuff that's on there, you're probably not going to be sure how to do. So we can help you with that as well. So when you're thinking about being prepared to borrow, there's a few different things that you want to think about. One is your legal documentation. And we'll go through specifically what some of these things look like, but you want you to think about having your proof of being in business and your tax and financial records. And then when you're looking at applying for financing, you want to also make sure that you've got all your financial documentation in place, and that is both personal and business information. Most lenders, no matter what stage of business you're at, they're going to want to see not just your business information, but your personal information as well. And we'll get into some of what those are. And I added this in recently. One of the reasons that I want to emphasize why it's so important to think about these things and making sure that you have these things in place to be prepared to borrow is not just for meeting needs of your business as they arise that you plan for, but also disaster recovery, right? I mean, we know, I'm based here in Charleston, and we have hurricanes, we have floods, we have all kinds of things like that. We had a pandemic recently that impacted a lot of businesses that there was funding available for. So when you're thinking about being prepared to meet the challenges that come with any kind of disaster, you want to have these things in place as well. So let's talk about legal documentation for a minute. What kinds of things do you want to make sure that you have? One is proof of your business organization, a certificate of existence from the Secretary of State. Basically, what I want to tell you is you want to make sure to have some kind of structure in place for your business. LLC, sole proprietorship is fine, but at least then you want to still have business license and that sort of thing. You want to make sure that all of the legal sort of documentation that you need to have, that you are a legally operating business, that you have copies of that on hand. For your LLC, you can file that online with the Secretary of State. There is a filing fee. We can help you do that. You file your articles of organization there as well. You're going to want to have a copy of that on hand. And even if you file online, the Secretary of State will send you hard copies of these through the mail, and you want to make sure to maintain them. A sole proprietorship, you're not required to file with the Secretary of State, but you still want to have copies of your business licenses and different things like that. So, and a lot of people say, well, okay, if I'm looking for financing, what if I'm a startup? Well, typically on the financing side of things, if you are a startup, you're not going to have these things to start the process of getting business financing, but typically to close a loan, you are going to have business license. You're going to have different, your proof of your LLC, different things like that, because most lenders are not going to lend to you individually. They're only going to lend to your business entity. So to close the loan, you're going to have to show that you have your business entity set up. So for your business organization, South Carolina also requires a retail license for all businesses operating in South Carolina that are assessed retail sales tax. So that's something that we can advise you on. You can also look at the Secretary of State website just to make sure that if you fall into that category, that you have that as well. Please make sure you have a business license and that you have a copy of it as required from the individual city or county that you operate in. There are some that don't require those. It's based on where you operate, but you want to make sure that you have that and that you have a copy of that. Please don't operate without a business license. You want to make sure that you have all that in place. This is required of all types of business organization, LLCs, other types of corporations, sole proprietorship, whatever you are. You still have to have a business license, depending on where you are operating. And then you also want to get an EIN from the IRS. You can get this for free. From the IRS website. We can help you do that. One of the things that I'd like to say here at this point is that with your LLC, if you decide to go that route with your EIN, we can help you to get those through the web at no cost. The only cost to you with that is your filing fees with the Secretary of State for your LLC or whatever else you get. There are companies out there and individuals out there that will charge you. I have seen up to $1,000 to get an LLC and to get an EIN. Just bear in mind that no matter what stage you're at in business, but especially when you're newer in business, every dollar matters. Your dollars are very important. So bear in mind that there are resources out there that can help you do that, us included, at no cost. Other documentation you want to think about having, figure out what your NAICS code is. North American Industry Classification System. Here is a website where you can do that. And what that basically does is it tells potential lenders, if you're going to get into government contracting or procurement, it tells them what kind of business you are in, what your business actually does. So it's something that you want to figure out which one you are. Again, we can help you with that and to have that information on hand. Excuse me. Please get insurance for your business, at least liability insurance, and have a copy of that on hand. You might want to think about, depending on where you're located. For example, if you're on Market Street here in Charleston, just as one example, you might want to think about getting some kind of flood insurance as well. Any kind of agreements that you have, like let's say that there's more than one of you that are owners of the business, and so you have a partnership agreement, or let's say you have agreements with suppliers or vendors. Any kinds of agreements like that you have copies of that you can provide. If you have any kind of certifications, women-owned small business, veteran-owned small business, minority-owned small business, anything like that, have copies of that. Have copies of your business plan. And as I said, these are all good things to have, whether you are an existing or a startup business. Now, as I said, if you're a startup, you can oftentimes start the loan process without having all of these things in place, but you're going to want to get them all in place before you actually close the loan. And so we can help you with that, but you want to make sure that you have copies of these documentations. And I'll say, and William can attest to this, like after COVID started, when there were different resources that were being offered by SBA and other entities, like the PPP, like the EIDL loans, different things like that. One of the challenges that a lot of businesses had was they didn't have a lot of this information in place. And so when you go to apply for that, you can't show your payroll. You can't show that you're even officially in business. You can't show a bank account. All of these are things that, and that's not the time when you want to have to figure out how to do that, because that's the time when you need the money in a hurry to be able to mitigate what your business is going through. So just something to keep in mind. Different kinds of financial information that you want to have for your business. You want to have ledgers, Excel sheets, different, however you're tracking your business finances. You want to be able to produce a profit and loss. You want to produce a balance sheet. And we'll talk more specifically about some of these things. You want to have your bank statements for your business that you can show. Tax documents, any loan documents for any previous loans you've taken. As I said, proof of insurance. Have a list of your equipment and inventory that you have that you keep somewhere, so that if you have some kind of loss or something like that, you can show that. Also, so that if you're going to go for a loan, potential lenders are going to look at that for collateral. So you're going to want to have that as well. If you're leasing a space, have a copy of your lease. If you're leasing any equipment, have copies of those as well. Any large equipment purchases that you've made, any machinery, anything like that, have copies of your receipts for those. That shows your investment in your business. If you are going for lending, that's a good thing to be able to show. And track your investment, your owner investment into your business so that you can show that. As we'll talk about in a little bit, most lenders are going to require that you invest at least 10 to 20%, maybe as high as 30% of whatever you're looking to borrow into your business. So make sure you've shown what investment you've had into your business. Personal information. Be aware that, for most lending, you want your credit score to be 680 plus. So if you haven't looked at your credit score in a while and you're looking to go for some kind of lending, pull your credit and see what's on there, because a lot of times what you're going to find is that there are things on there that aren't accurate or that shouldn't be on there. And those are things that you want to get resolved before the lender looks at it. Make sure that you don't have any delinquencies. Make sure that you're current on your taxes. Most lenders are going to ask you for at least 2 to 3 years of personal tax returns. As I mentioned, 20% at least for equity. Be prepared to show your previous investment and have bank statements and other documentation for your personal finances as well. So what do you need for a loan application? You need a business plan, which we can help you pull together. You're going to want at least 2 to 3 years of projections, monthly at least for the first year, for startups and existing businesses. So a lot of people ask me, I'm an existing business, why do I need projections? Well, so if you're a startup, obviously you need the projections because you want to be able to show the lender that you can grow the business to the point where you can successfully repay the loan. If you're an existing business, they're still oftentimes going to ask you for projections to go along with your financials. And the reason for that is because what the lender wants to see, and full disclosure, I was a previous small business lender in my former life. So what we're looking to see is what impact is this borrowing going to have on your business? Okay. So in other words, if you're coming in as an existing business, it's either because you're looking to expand or grow in some way, or because you're having some kind of financial issue that you're needing to meet. And so either way, what we want to see is what impact is this borrowing going to have on your business, and can you repay the loan? Same as what we would be looking at if you were a startup. We look at it a little differently because you've got the business financial history as well, but we still want to see what that impact is going to look like on your business financials. We're going to ask, the lender's going to ask for a personal financial statement. They're going to pull personal credit history. They'll want to see a resume. So if you are, especially if you're a startup, if you are newer in business, they're going to want to see, what experience do I have that will contribute to me being successful in this business. Make sure you've got business and personal tax documents, profit and loss and balance sheet, bank statements, typically at least for a year, a cash flow statement. There is a difference between a profit and loss and a cash flow statement. And we'll talk a little bit about that, and we can help you work out each one of those. Loan documents for any existing loans that you have, and then a list of anything that you have that you can use for collateral. These are all typical things that a lender is going to ask for, and we can help you pull them together as well. Business plan, they're asking for that typically because what they want to see is, what the business plan does is it precisely defines your business, it identifies your goals, it serves as your firm's resume. Your sales plan, your marketing plan, your pricing, how you're going to operate, what your cash flow looks like, all those things. But the primary reason you put together a business plan is for you. first and foremost. It helps you to allocate your resources properly, figure out how you're going to operate this business, handle unforeseen situations and complications, and make the right decisions. For the lender, they're looking at this to say, have you thought through this business? Have you planned through how this business is going to operate, what it's going to look like? And you know what your potential strengths and weaknesses are, how it's going to grow financially, how you're going to find customers, how you're going to market, all of these things. And again, you know, this is really, really crucial to do when you're at a newer startup phase, but it is really crucial to do at any stage of your business if you haven't done one already. It's crucial to revisit it. I recommend at least quarterly as your business grows to see where you are in relation to where you thought you were going to be with the business, and so that you can start to transition more into a strategic planning mindset of, okay, I've opened my doors, I've been in business for a little while, I'm making money. Now, what does this business look like for me over the next 2 years, 3 years, 5 years, 10 years? What do I want my growth trajectory to look like? And so you can start to think about those things as well. And sometimes a lender is going to ask you for one, even if you're an existing business, because again, if you're having either an opportunity for growth or some kind of challenge as a business that you need additional capital for, they're going to want to see how you plan for that and how you're going to manage that growth or manage coming through that challenge. And they'll ask you to put together a business plan to do it. So key takeaway there. If you've done one, continue to revisit it periodically. If you have not done one, it's never too late. What we're looking for, what the lender is looking for, clarity of thought and purpose. Do you understand what your business is and why people need it? What's your market? Who's your market for this? And it explains your business model. How's it going to perform and will it grow? I hate to say this, people get mad at me, but you know, if you do not have customers for your business, if you do not have people that are actually buying whatever product or service you're selling, you're not really in business. You really have an expensive hobby. And so that's one of the things that this plan can help you do, is to figure out, okay, how do I take this thing that I am passionate about, this thing that I'm good at, this thing that I need to see a need for, how do I transition this into a successful, growing, profitable business? And that's what this is going to help you do. What are your qualifications to do this? And then tell us about your market and your competition. Are there actually people out there who want your product and service? 99.9% of the time there are. And then once you figure out that there are and who they are, how do you find them? How do you get the word to them? How do you let them know to come to you? And then your SWOT, your strengths, weaknesses, opportunities, and threats. This is a way of planning out, understanding the advantages of your business and also understanding the potential obstacles and threats to your business. It can be a challenging exercise, but it's really important, and we can help you do it. And then also from a funding perspective, you know, I'll tell you from when I used to be a lender, I would generally read the executive summary of a business plan. I would generally look a little bit at the marketing plan, and then I would go straight to the financials. Because what the lender is looking to see is how much money do you need and why? How are you going to use it? Okay. And what impact is it going to have on your business? And have you thought through and do you understand those things? The worst thing you can say to a lender is if you sit down to have a conversation with a lender and they say to you, how much money do you need for your business? And you say, well, how much can I get? That is the wrong answer because what the lender wants to see is, have you thought through and planned through what your needs are, why you need it, and how you're going to use it. And the reality is, a lot of times, and I speak from my own experience as a lender, we would end up telling people that they needed more money than what they were asking for to really meet the need that they were having. So don't don't go into it with the mindset of, well, I need to ask for more, or I need to ask for less. Go into this with the mindset of, I need to figure out how much I really need to make my business successful, and we'll work through it from there. So once the lender gets all this information from you, what are they looking at? What are their key deciding factors? And the reason that I bring these up is because these are things that help you determine whether or not you are ready to go borrow, or whether or not you still have some work to do before you put in a loan application, by figuring out where you are on these different things. You'll hear these sometimes referred to as the 5 C's of credit, the 5 C's of lending. Sometimes you'll see them referred to as other things, but these are the basic things that lenders are looking at to determine whether or not you are ready to receive financing. Because I'll tell you, there's a lot of different kinds of lenders out there. And yes, they care that your business is successful. Yes, they care about what you're doing. But really, first and foremost, what they're looking at is, can you repay me? Right. So that's what they're assessing here. The first of the 5 C's, we talk about character. The primary thing that they'll look at there's two primary things. One is credit history. How are you at repaying your bills? Because the reality is, if you don't pay any of your other bills, you're not going to pay this loan either. If you do, most likely you're going to pay this one also. Now, that said, most lenders will look at your credit and they will understand if you have gone through a difficult situation, that you have rectified that and you're now on a good path. Generally, as long as you've turned it around and you are going in a good direction and you're paying your bills, then most lenders will understand that. As I said, you want to be at least 680 plus on your credit score. And as I said, if you're going to, before you go for any kind of financing, and this is true whether it's business related, whether it's a home, whether it's a car, whether it's anything else, pull your credit report and know what's on there, because a lot of times there might be things you don't know about, things that are on there in error that you can fix. So make sure that you know what those are. The other aspect of character is your qualification. If you come to me and say, I want to open a restaurant, one of the first things I'm going to say is, okay, what background do you have in the restaurant industry? Because if you don't have any, that's a hard lift. And the first thing I'm going to probably tell you to do in that case is go out and get a job in a restaurant and see how much you can learn about the industry. Excuse me. Most lenders want to see that you have some kind of qualification in the field that you're going to go into. Another aspect of what you're going to want to have on this is your personal financial statement. Some of you might have filled one of these out before if you went for a mortgage or anything like that. It's basically a statement of your assets and liabilities. How much cash do you have? How much do you have in retirement, real estate, stocks and bonds, anything like that? And then what are your liabilities? How much debt do you have? Credit card debt, car loans, student loans, anything like that. What the lender is looking to see here is, do you have cash of your own that you can put into your business? Do you have cash of your own that you can continue to pay your personal bills if we give you this loan? And what do you have on here? Houses, cars, anything else that could potentially be used as collateral. When you do your net worth, if you don't own a home or you have student loan debt, which a lot of people do, then a lot of times your net worth is going to be negative. That does not necessarily disqualify you from qualifying for a loan. It just means that the lender has to look at things like, okay, how much cash do they have in the bank? How much debt is there? What kind of outside income do they have? So don't necessarily think that that disqualifies you, but that's what the lenders are looking for. Capacity. If you're an existing business, can you pay your bills when they're due? And is there any cash left over at the end of the month? So if I give you a loan, do you have the capacity within the business to repay it? If not, or if you're a startup and you don't have a business financial history, can you as the business owner personally repay the loan if the business isn't able to? Is there an outside source of income from either you, from a spouse, from an investor, family member, whatever, that can repay this loan? Collateral. We believe as lenders, and lenders believe, that you are going to repay your loan. But if you don't, for some reason, what else can be used to secure the loan? That can be hard assets. The most common ones are hard assets and personal guarantees. Some examples: real estate, taking a lien on your house, vehicles, FF&E, furniture, fixtures, and equipment. That's the stuff that's in your business. Any furnitures and fixtures, any machinery, anything like that that belongs to the business. Inventory is not typically used as collateral because we want you to sell it. And collateral is not meant to be sold. Personal guarantee means you're signing on to that you are pledging to repay the loan if the business is not able to. You can also get guarantees from outside sources, from other individuals, whether they be family members or whoever. You can get them from outside businesses. So that's another way. It's basically a cosigner for the loan. That's another way that you can secure it. The capital piece, do you have personal investment? Minimum of 10 to 20, sometimes up to 30%. Remember, track your own prior investment in the business so you can show that to the lender. Also, if you're an existing business, be able to have some kind of financials where you can show how much the business is reinvested in itself, what we call retained earnings, right? How much of what the business has made has gone back in. And have your business financial history to show those things, the profit and loss, the balance sheet, cash flow statement, and bank statements. And then conditions. Does what you're wanting to do make sense? Based on the market, based on what others are doing? Do you understand how you are going to deliver the product and service that you are, or service that you're providing? Is there seasonality in your business? Meaning, are there times of the year when you do better than others? And are you prepared to meet those? Should I own versus should I rent? Location is really important in this. You know, the example I always give is if you're going to open a coffee shop, don't open it right across from a Starbucks. Find another location, right? And then who's your competition? What are they doing? And how do you differentiate yourself? Then you want to have your source and use of funds. And we have some templates and things for this that we can help you put it together. Know how much you need and how you're going to use it. And then projections. So typically 3 years. This is where you are projecting how the business is going to perform over a period of time. Typically 3 years, typically monthly the first year. Now, why monthly the first year? I'll show you an example in a second. You want to have profit and loss and cash flow. I'm not going to go through all this. I will share this with you. This is an example of a projection. We have templates we can provide you, and we will work through this with you. But what I want to show you is why, if they ask you for monthly projections, why are they doing that? Well, so if you come down here to your net profit, look what's happening over these 4 months here. You start out profitable, and then by the end of the 4th month, you're losing money. So the reason I say that is because when you're going for a loan, okay, so when you think about things that you can use the loan for, inventory, equipment, payroll, all of these things, you want to make sure that there is working capital built into it to help you meet your monthly operating expenses so that you can, kind of cover those gaps that might cause you to not be profitable. And we can help you figure out how to do that. Profit and loss projection, what that tells you is how much of something am I selling every month? What are my expenses? And am I profitable at the end of the month? How much revenue do I have left over? Cash flow tells you how much cash do I have in the bank at the end of the month? And is it enough to meet my expenses for the next month? Think about it the way you think about your personal finances, right? So you make a certain amount of money from your employer every month. You have a certain number of bills. What you want to know is how much money is left in my bank account at the end of the month. That's what the cash flow projection tells you. It is possible to show that you are profitable on a profit and loss and still lose money on the cash flow statement. I'm not going to go into these in a whole lot of depth. If this is something that you need assistance with, I can certainly help you with it. We have other consultants who have, but just have in the back of your mind that this is something you're going to need for your loan package. So last thing, I wanted to just give you a couple of options. So one of the questions that we commonly get is, what are my options for financing if I am looking for funding for my business? And there's a bunch of um, personal funds is one, your own investment into the business. Individual investors, whether they be family, friends, or whether you go through like an angel investing network or something like that. Um, Grants, we get the grant question a lot. I'll talk about that in a minute. Conventional bank financing, online lenders, crowdfunding, and then there's some other non-bank funding sources that we'll talk about as well. When you look at personal funds, I mentioned your equity investment. What are some places that you can get this? Save money. When people ask me, what should I do to prepare to start a business? The first thing I say is start saving money. So any money that you've saved up, you can borrow from home equity. That's a way that a lot of people do it, taking a home equity line of credit. Some people tap into their retirement. I highly, highly discourage people from doing this unless you absolutely have to, because the tax consequences of that are severe. And also, you don't have as much retirement then when you actually get ready to retire. So it can be done, but I encourage you not to. I encourage you to look at savings, home equity, and investors first. Individual investors, this can be family and friends. Angel investors, venture capitalists, if you're in the high growth tech field. What I always recommend to people, because typically people will say, well, my parents, my siblings, whatever, are giving me money. If you do that, get something in writing about the terms of it, because you don't want it to be awkward at your house at Thanksgiving when you haven't repaid your brother for the loan that he gave you for your business. So I just encourage you to work all of that out as part of the process. Grants. There are not many that we know of for starting or expanding a business. There have been some more opportunities since the pandemic. What we typically tell people is, if you find a grant, if we hear of something, we'll share it with you. If you find a grant and you need that you think you qualify for, and you need assistance figuring out if you qualify or putting the application together, then we certainly can help you do that. There are a couple avenues for grants. One is in innovation and research and development. There's what the Small Business Innovation and Research and the Small Business Technology Transfer, which are federal grant programs for helping with technology development. And then there's also different sort of rural development agribusiness grants available through USDA and other sources if you're in the agribusiness space. Conventional bank financing, this is where this can be a challenge. What's a challenge for a lot of businesses is their time in business. You have to be in business for at least 2 years typically before a bank is going to consider you for financing. What I encourage you is, if you're new in business or if you haven't done it already, establish a relationship with your bank so that they know who you are, so that when you get to the point where you start qualifying for credit cards, lines of credit, loans, things like that, it makes that an easier process. Also, don't assume that all banks are created equal. That's something that we can talk with you about in terms of which banks might be a better fit for you, depending on what kind of business that you have. They're going to look at personal and business credit. It's typically higher for banks than it is for other kinds of lenders. Typically for a bank, you're going to want to have at least 700. The loan amount is an issue sometimes as well. Typically, they're not really all that interested until you get up to the 300,000 or up. Just looking at return on investment for banks. There are some SBA programs which involve a conventional bank financing component, the 504 and the 7A, which William Furman will talk with you more about in a minute. There's a lot of online lenders out there. These are just a few examples. These can be good resources for you in some cases. However, I encourage you to be cautious, because typically the easier it is to get money, the more it's going to cost you to have it. And with the online lenders, they typically will give you more money in a shorter amount of time with less sort of paperwork and stuff involved. I totally understand. Sometimes that's necessary, but it also typically comes with higher interest and fees and shorter terms. So you want to be cautious about that. Crowdfunding can be another example. These are a few examples. You might have heard of some of these of crowdfunding sites. This is where you can go on and individuals can donate money to you essentially to help you start or grow or stabilize your business. And then there's several sort of non-bank financing options out there. There's different SBA loan programs, which William's going to talk to you about. There are community development finance institutions and community development corporations, which we have connections with a lot of these that we can point you to. They specialize in lending to either newer businesses, startups, or those where there are credit challenges, they're not profitable and have financial challenges, things like that. So I say that to say, no matter what stage of business you're in, or no matter what challenges you're having, there are options out there for you. Venture capital can be an option for you. It's typically geared more at higher dollar tech companies, but there are some of those things out there. Invoice factoring can be another one. The way this works is if you have a contract to deliver a product or service, you can then basically sell that to a company that will give you, potentially up to 80% of the value of it, minus some interest and fees. And that can be another way to finance, because essentially all that takes into account is a contract or agreement that you have. There's not as much involved in it in terms of personal finance or anything like that. Merchant cash advances. So if you are a business that takes credit cards, which 99.9% of them do, and you have some kind of credit card processing service, they will typically offer you what's called a merchant cash advance, where somebody will come in and say, okay, we will give you a working capital loan and we'll just deduct a certain percentage of the sales. It's typically somewhere in the neighborhood of 3% a day or a week, something like that, to pay back that cash advance. What you want to be careful of with that is read the fine print, read the terms. I would encourage you that with every potential financing option, because it can be a little bit expensive in terms of interest and fees. Also, don't forget about seller financing. If you're looking to buy a vehicle, if you're looking to buy any kind of equipment, anything like that, consider seller financing as an option. Sometimes it's not the best option to get a bank business loan to buy a vehicle. Sometimes it's a better option to get a loan through the dealer. So again, look at all your options. We can help you do that. Read the fine print. Know that there's a bunch of different options out there, depending on what stage that you're in, that can help you. So just as a real quick summary, what should you know? There's no such thing as 100% financing. You typically have to have at least 10 to 20% equity to put into your project, or that you've already put in. Your personal credit history is important. Your credit score is going to be a factor. They are going to look at it. Collateral is going to be required. They're going to want to take something as security for the loan. A personal guarantee is often going to be required. So be prepared to pledge personal assets and to sign a personal guarantee, because pretty much any loan is going to require that. So here's our website. If you need help, you can come on here and sign up to request counseling. This is my contact information. I'd be happy to work with you or find someone else in our office to do it. So thank you very much. I think we'll answer questions at the end, but I will turn it over to William Furman from SBA.
Awesome. So Paul, thanks for inviting me. It's always good to tag team with you. My name is William Furman. I'm in the Charleston, what we call the alternate work site in North Charleston, and I cover the coastal area of South Carolina. So from Myrtle Beach, Horry County, down to Beaufort, really back to I-95, and cover all SBA programs. And I am really pleased to have Earl Gregorich with us today. Earl is brand new to SBA. And Earl, do you want to just unmute for a second and tell the group who you are and where your office is?
Sure. Thanks for giving me an intro there. I'm up in the Duncan office here in near Spartanburg, South Carolina, and I cover 20 counties in the upstate, basically from Rock Hill to Georgia down to Greenwood. So happy to be here today. Thanks.
Awesome. Thanks for jumping on for this. So I'm here to talk, really about SBA, and want to make sure that you understand, who SBA is and what we do. And so we like to say we start, grow, and expand, recover small businesses. And what that means is that we provide businesses support for business counseling, and we really do that through our resource partners. And so the SBDC does an absolutely great job in doing this. They serve as our boots on the ground. We do have a few others that I'll talk about in a minute. So that's one focus that we have. We also have our lending programs, which we're going to talk about in some depth today. We're not going to dive too deeply in that, but hopefully you're going to have a good understanding of how those work when you leave today. Then we also have government contracting programs that would be for the federal government. We provide programs to assist small businesses to do business with the federal government and access those federal contracting dollars. And then finally, we also have our disaster recovery programs. Paul touched on that earlier. But anytime we have a federally declared disaster, SBA will be on site, as will FEMA. And SBA can provide low interest, long-term loans for uncompensated losses in the event of a disaster. And so those loans can go to, actually, those loans can go to more than small business. They can go to large businesses, small businesses, homeowners, and even renters in those situations where there is an uncompensated loss. That SBA disaster loan can make those individuals whole after the disaster. So very important program there. It's not a matter of if Charleston or the Low Country is gonna have another hurricane. It's just a matter of when. So it's just really good to know that that is available out there. So that is what SBA does. Those are our 4 core areas. And so it's important to know that. So these are I talked about our resource partners, and you're on this webinar, so you know about the Small Business Development Center. But we also have SCORE, we have Women's Business Centers, and we recently were able to obtain funding for a Veterans Business Outreach Center, which is located at the Citadel. And so, SCORE kind of takes the approach of mentorship for small businesses. Women's Business Centers, as you would think, they focus on woman-owned small businesses. And then the Veterans Business Outreach Center, or VBOC as we call it, focus on the, and so I think we are sharing these slides after the presentations, and these are live links. So once you get this, you can go back and get more information on all of these and find out contact information and that kind of thing. There is a lot of overlap between the various resource partners, but we all pull the same. I will say that we all work well together. You can actually receive services from more than one. It's not a big deal. Sometimes they'll refer, you'll get referred from one partner to the other, because we all, we're trying to work collaboratively. And, the bottom line is that we want those small businesses to receive assistance. So we're here today to talk about access to capital and how SBA can do that. And so we really have a couple of different programs that we use to provide capital to small businesses. And we're going to talk really primarily about the number one here, and that is what we call the SBA backed loans. And so I'll explain exactly what that means and how that works. But we do have programs for private investors. We have research and development awarded funds, and those would be actually grants, but it is for research and development. As Paul mentioned, we do not have any grants to help you start your business or grow your business. It's only R&D. And then one other thing, if we have any contractors, construction companies on the call, we have a guaranteed surety bond program that can be of big assistance too. A lot of people don't know about that one, but SBA does have this surety bond guarantee that can help your business get bonding, that can help you increase your bonding, it can help you reduce your bonding costs. And so we do workshops on that one every once in a while. And in any of these, if you have if you want more information, you're welcome to reach out to me, and I can make sure that I get you what you need. So when you need funding to help your business start, grow, or expand, where do you go? What do you do? So SBA works with approved lenders to offer microloans and SBA-backed loans with competitive terms, lower down payments, flexible overhead requirements, and especially with the microloans, it comes with counseling and education. And so what we mean by SBA-backed loans is that it is SBA provides a loan guarantee to the bank. So SBA does not actually make the loan. SBA is not the actual lender, but SBA does provide a loan guarantee to the bank, which reduces the risk to that loan and therefore encourages the lender to make loans to small businesses. And so I think we'll got to have a couple more slides on that, and I think you'll get a better idea of exactly how it works. But so how does an SBA 7A loan work? And this is our real bread and butter loan program. This is by far the majority of the loans that we make are 7A. And so you're going to start with your business plan. Paul did a really good job about talking about your plan and, the documents that you need to include in your loan package. And so you're going to pull all of that together. I like to call it becoming lender ready. And so once you become lender ready, you're ready to actually submit your application. And so we recommend that you apply with a lender. And usually you would start with the bank that you already have a relationship with. And Paul talked about that. It's very important for you to know the commercial lender with the bank you do business with, and if you don't, if you're making deposits, just stop in and talk to the branch manager. They'll be more than happy to talk about your business and what you're doing. And, maybe you have some future plans for expansion or growth. They want to know who you are. And so I highly encourage that you develop that relationship. So once you decide what lender, it is really up to the lender to decide whether they are going to use SBA or not. And so I like to explain this as a spectrum. On one end of the spectrum, you've got your very best business borrower, and that borrower, they've been in business for several years. They have equity in their business. They have good collateral. They have a good business model. They have a good track record. Everything is positive on their side. And so they can really go to any lender in town and get a loan. And so that is not the customer for SBA. And they're actually not eligible for SBA because they don't need the loan guarantee or the backing to get a loan. Now, on the other end of that spectrum is a business or potential borrower that is just not bankable. Maybe they have a very poor credit score. Maybe they don't have a good business plan. Maybe they don't have the adequate equity in their business to get a loan. And so they're just not bankable. So SBA falls somewhere in the middle. You have a business, it could be a startup business, right? So maybe a bank isn't real interested in financing that startup business. As Paul mentioned, they haven't been in business for 2 years. Well, they can use this loan guarantee, and that helps mitigate that risk. Same thing goes for collateral. Maybe there's a collateral shortfall. That loan guarantee can help overcome that. Maybe they need longer loan terms, and a lender can use our SBA loan guarantee to give extended terms, 25 years for real estate, 10 years for working capital, which conventional lenders are typically not going to do. So those are the kind of situations where that lender will determine that, hey, I like this project. It just falls just a little bit short, but if I can use an SBA loan guarantee, I think I can get the deal done. And so that's where SBA comes in. And so SBA, they choose SBA, they submit it to SBA for approval, and SBA will process that and issue the loan, what we call the loan number. And when we issue the loan number, that is actually the guarantee to the lender. So SBA does not provide the loans. As I mentioned, we provide the loan guarantees, and that is with the exception of our disaster program. So our disaster program is the only time that we provide loans directly. SBA does not have grants for small businesses. We've talked about that. You know, we do have some of those research and development programs, but we don't have anything to help you start or grow your business. We don't set the interest rates, and I do have a slide on that that we'll talk about a little bit more, but you negotiate your interest rate and the term of your loan with the lender, not SBA. SBA does impose caps. We don't allow lenders to charge just anything, but you negotiate that. And finally, SBA cannot force a lender to approve a loan for a small business. This is entirely up to the lender. You know, for this program to work, it takes all three parties. You've got to have the business, you've got to have the bank, and then you have to have SBA. And everybody has to be on the same page and in agreement for that to work. So how can we'll just say a 7A loan help you? So it can be used in a lot of different ways. You know, it can be used to help you start your business, grow your business. It can be used to access revolving lines of credit, working capital, day-to-day expenses, purchase, renovate, or expand facilities. You can purchase inventory, equipment, and machinery, land or real estate, and we also have export product or services. So a lot of different programs that can be used a lot of different ways, and so it's you know, it can be a real benefit. A few of the benefits of the SBA loan. So longer financing, I mentioned this, up to 25 years for real estate. Interest rate max is based on Wall Street prime rate, which I think is still 8.5%. You know, it's getting really high. I'll just be quite honest. It is expensive to borrow money at this point in time, but you know, we're still making a lot of loans and things are going well, but you just have to factor that in. By extending the term of the loan, you can lower your payments. We do not allow renewals or balloon payments. And so if you don't know what that is, sometimes banks will amortize or you know, they'll set the term of the loan for, say, like 25 years. However, it will have a renewal in like 5. And so, you know, when you get to 5 years, then you've either got to refinance that, and we call that a balloon payment. You know, once you hit that renewal period, it balloons and it's all due. And either you've got to restructure it, refinance it, or, you know, you've got to do something with it. And we don't allow that. So it's a straight term loan. And so you don't have that to worry about. We do allow for the potential of collateral shortfall, and that is a big reason why lenders like SBA and use SBA's guarantee. So if you have a business and you're trying to obtain a loan and you do not meet the collateral credit criteria of the bank can use the SBA loan guarantee to mitigate that collateral shortfall. A lot of people like to say we're the ultimate cash flow lender because we rely on cash flow of the business, not the collateral for loan payment. And so with that, it also increases your cash flow. So you can see it can be very beneficial, a lot of advantages by using the SBA loan program. All right, let's talk about our guarantee and fees. And as a business, you're really not too concerned about the guarantee percentage. That's really more for the bank. You know, that kind of dictates to them what they can do with the guarantee. But for loans of $150,000 or less, SBA does give an 85% guarantee. And just for example, let's look at a worst case scenario. If you had a loan and it went into default and the bank lost, they had $100,000 loss on the loan, all the collateral's gone, they would come back to SBA make demand for payment, and SBA would for on $100,000 they would pay them $85,000, and the bank would only be out of 15. So not a bad deal for the bank, right? That's pretty good. It really helps them, and again helps them get over the hump. You know, once it goes up over 150,000, the guarantee does drop back to 75%. Now fees, SBA does charge fees because we try to operate at what we call a zero subsidy rate. And what that means is that we can operate this program without having to go to Congress for funding, okay, for the actual loans. And so we generate some funding to cover losses through these fees. Now they change every year, and for this year, loans of $500,000 or less have a fee of 0. Okay, so it's a really good deal this year for those loans of 500,000 or less. Now, once you go over 500,000, it ranges. It depends, you know, on the term of the loan, the amount of the loan, but it ranges from 0.55% to 3.75% of the guaranteed portion of the loan. And typically those fees are going to be included in your loan amount. That's usually what happens. Now, the maximum size of the loan is $5 million, which equates to a loan guarantee of 3.75 million. So these loans can be quite large, but we see small ones as well. We do have lenders now that are doing smaller loans. So you may see a loan for, you know, $25,000 up to say 5 million. So, all right, eligibility. You know, really any type of business is eligible. We do have some that aren't, and I'll talk about that in the next slide. One of the big things is the size of the business. It does have to be considered a small business. And the size of the business is determined by your NAICS code, North American Industry Classification System code. And every industry, every NAICS code has a definition for what is considered small. But I will tell you, over 99%, that's right, 99% of businesses in South Carolina are considered small. So very few are considered large. And that NAICS code, you know, if you look at those definitions, it's broken down by the type of industry. But for like manufacturing, some of the manufacturers can have up to 1,500 employees and still be considered small. And so you can see, you know, SBA's definition of small business and say my definition of a small business aren't necessarily the same. So some of these businesses are considered small, but, you know, they're really pretty large. You know, the purpose of the loan, it can really be, can't be used for anything illegal. It does have to be located in the U.S., must be a for-profit. So we get this question a good bit, or calls from nonprofits seeking assistance on loans, and we cannot make loans to nonprofits. So that takes them out. And of course, you have to demonstrate the ability for repayment. If you can't generate a positive cash flow and debt service coverage, then your loan would not be eligible. All right, businesses that aren't eligible. So any type of investment activity or speculation is not eligible under SBA. So that takes out real estate investment. You cannot be a lender or have any kind of lending activity associated with your business. Pyramid sales. Long-term real estate rental is not eligible. You know, hotels and that kind of thing are. But if you were renting a house on, you know, long-term basis, that would not be an eligible SBA purpose. Of course, I mentioned everything. You can't do anything illegal. Nonprofit businesses not eligible, and then businesses that limit membership for any reason, and that would be something like, let's say you had a women's health club and they only allowed women into the facility, that would not be eligible. All right, terms and conditions. Maximum term, 25 years for real estate, 10 years for working capital, machinery, equipment, furnitures, and fixtures. Interest rates depend on they vary depending on each loan program. The lender does determine interest rate based on risk. So let's just look at some of these rates. And again, I think prime is 8.5%. And so if you look at these are the caps. This isn't necessarily what will be charged, but these are the caps. And so on the 7A loan program, let's just say it's a loan of let's just say it's a loan of over $350,000. That's going to give you what, 11.5% as an interest rate. And then of course, if it's smaller, then that rate goes higher. Now that is the maximum. And honestly, I see a lot of lenders that they're not charging the maximum rate. You know, they may be charging prime +1, prime +2. So it's just important for you to talk to lenders, see what they're doing, you know, see what rate they would charge, what their term may be. We do have programs, cap line. These are line of credit programs. Just want to mention that. And we have an SBA Express program. This is a very quick and easy program. Banks like it because of that. It's limited to $500,000. It only has a 50% guarantee. But one of the things it can be used for is a really easy way for a lender to make a line of credit. And so they can make a line of credit to a bank or to a business using the SBA Express program. That line can be extended for 5 years and then termed out for the balance of the 5 years for a total of 10. So if you have a 10-year loan, you can have that line of credit active for 5 and then term it out for 5 for it to be paid off. Veterans, just want to, this is a thank you for their service. We do have a Veterans Advantage Express program. It is maximum of $500,000. It comes with no fees, and it has the same underwriting as the Express program. But the thing about this one is that it is set, so it doesn't matter. You know, our fees vary from year to year, but not with the Veterans Advantage. So veterans will not be charged fees under this program up to $500,000. So just want to say thank you for that. If you're seeking fixed financing for real estate, major pieces of machinery and equipment, a 504 certified development company program could be good for you. So long-term fixed assets, fixed financing, up to $5 million. And it's a leverage program, as I call it. 40% is done by a CDC. A commercial lender does 50%, and the borrower contributes 10% for 100% of the project cost. Now, the beautiful thing about this is that for real estate, it can have a 25-year term, and the interest rate is set by debentures, and those debentures right now, the rate I think is about 6%, right? So prime is 8.5%. So you're getting that at a below prime rate for 25 years, and it's fixed. So that is a very good deal. You know, if you're looking at buying a building, buying real estate, building a building, this would definitely be a program you should consider and take a look at just to see how it would shake out with some of the others. Yep. Okay, loan options for startups. We do have a community advantage program. It's the same as the 7A. It just is a little bit more liberal, makes it a little bit easier for these community advantage lenders to make loans. And then we also have a microloan program. I want to talk about that one a little bit more. We do see this one used extensively for startup businesses. It does have a maximum of $50,000. Minimum of 500. Its minimum is probably more like 1,000, but really good program to help small businesses get started. The maximum term is 7 years. The interest rate is based on a 5-year treasury. And so those rates, you know, they're probably around 10% at this point. And it just is a really good way that to give these micro lenders flexibility to help these small businesses get started. And so we have Community Works up in Greenville. We have the Climb Fund in Charleston, and both of those are very active. They do an awful lot of microloans, and it's just a good way. So commercial banks many times don't want to make those smaller loans, so it kind of leaves the small businesses hanging. Even if they have a good project, it leaves them hanging a little bit, and these microloans fill that gap. So that's a very good alternative. In addition to this, you also receive technical assistance and training when you get this. It's not like the micro lender gives you the loan and says, congratulations, your first payment is due in 30 days. They will help you analyze your business, see where you need help, and make sure that you have that help so that you can be successful. All right, I've just put these slides in. Paul has talked about them, but I think it's important for you to understand if we have them in here twice, you know, it's probably pretty important. And so just want to make sure you know that our resource partners, whether it's the Small Business Development Center, SCORE, the Veterans Business Outreach Center, the Women's Business Center, they can all assist you with business plans, your expense sheets, financial statements, and financial projections. Lender Match, this is one I want to touch on. This is on the SBA's webpage. This is a tool to help you if you were having trouble getting connected with an SBA lender. And so we have a program called Lender Match. It's on our website. You can go and you answer, I think it's about 20 questions. You create a profile for your loan request. And then once you submit it, it goes out to SBA participating lenders, and you will get a reply from those lenders who are interested. It doesn't ding your credit. It's you know, you're not obligated to in any form or fashion. Neither is the bank. It's really just a way to get connected and exchange contact information. Now, I will warn you, if you do this, you will get a lot of replies, and a lot of them are from fintech or online type lenders. Now they have been vetted by SBA. They actually make SBA loans, but they are online lenders, and so just be aware of that. You know, I kind of like to have a local lender myself. You know, if I were if I were applying for a business loan, I kind of like to have somebody I can go to and look in the eye. And some of those are on Lender Match too. But again, just be aware and be advised when you do it, you're going to get a response. And so just be ready for that response. Same thing Paul's talked about: character, cash flow, collateral, capitalizations, and conditions. And so here's what I see, and I'm just going to spend a second on this. You've got to know what your credit history is. You've got to know what your credit score is. Know that up front. You've got to know your financial statements and projections, and you've got to be able to show that cash flow that you can repay the loan. Collateral, you need to know what you have available. Now, if you don't have enough to cover the loan, it's not the end of the world. The SBA loan guarantee can help with that. Capitalization, you can't expect the bank to finance all of your business, right? You've got to have skin in the game. As Paul mentioned, 10, 20, 30%, you need to have that on hand. And so those are really the things that I see that hold people up. You know, if they don't have the money to invest in their business, you know, they need to either, you know, find a partner or save their money and get there. So I just wanted to underscore this particular slide. Excuse me. All right, this is an excellent opportunity. This is worth the price of admission right here on its own. We are having a Myrtle Beach lender matchmaker, and I know you know, the Charleston SBDC is here in Charleston, but this is just right up the road. We will be doing one of these in Charleston in August. But if you're seeking financing right now, this is a really good opportunity. We're doing this in conjunction with the city of Myrtle Beach, and including SBDC and SCORE. It will be February 29th from 10 a.m. to 2 p.m. at the Myrtle Beach Convention Center. It is intended for lender-ready businesses, meaning you should have your business plan and financial projections, but it can be an existing business or startup. I think we're at about 14 different lenders right now. We have all kinds of banks coming. We have commercial banks, community banks. We got our micro lenders. So the Climb Fund's going to be there. Community Works is going to be there. And so it's just a really good opportunity if you're seeking a loan and you want to talk to some banks. You can do this all in one place at one time. You meet one-on-one with the bank. You pitch your request in what we call speed dating format, meaning you have about 15 minutes to explain your loan request and your business. And then if it looks like something that the bank might be interested in, you would share your contact information and follow up with an appointment to push your application forward. So we do have the registration link here. And if, excuse me, if you have any questions, please feel free to reach out to me as well. Just a few helpful resources here. I'm not going to go through all these, but I just wanted you to have the links for that. All right, here's my contact information. And I think we're at a point now where we can take questions.
From Michael Bailey, do market futures count as collateral?
Not typically.
Yeah, not normally.
Typically, the most common things for collateral for security for a loan is going to be those hard assets, the real estate, the equipment, FF&E, that sort of thing, or personal guarantees.